Federal Bank is on our radar now. IFC has invested almost 959 crores in Federal Bank via the preferential allotment route. IFC's holding in Federal Bank has now risen to 8.1%. Also, Federal Bank's QIP of 3,040 crores is getting a very strong response. Harsh Dugar, who's joined as the Executive Director at Federal Bank, joins us now on the show. Harsh, thanks a lot for joining in and appreciate your time here. Wanted to start by asking you, post this fundraising, what would the cost of funds be in the near term? Would this help in controlling cost of funds? And what's the outlook?
Good morning, Sonia, and thanks for inviting us to the show. Yeah, the two parts. One is the cost of deposits, which we have seen an increasing place across the banking industry, but largely we have seen that getting priced in. So the last quarter probably saw the tail end, the fag end of the pricing in of the high cost of deposits. We are raising about 4,000 odd crores, between 3,000 crores for QIP and another 1,000 crores, 958 crores to be precise, for the preferential allotment. This will definitely help us in bringing down the cost of funds, but this is the cost of deposits still has plateaued out, seems to have plateaued out now.
Okay. That will help you in bringing down the cost of funds. Got that. I want to talk a little bit about the overall business. There is this expectation that loan growth for you will be in this range of around 18 to 20%. It's something that you folks have spoken about in the past as well. But just trying to understand, where is the maximum traction coming in from? Whether it's from corporate, retail, agri, where are you seeing maximum demand? And this 18 to 20% is something that you can hold on to in FY24. And what's the outlook for FY25?
Yeah, we've been guiding the markets that we've been looking at growing at 18 to 20% growth, and we don't see a challenge over there. Both the rural demand and the urban demand has been quite fairly robust. Between corporate and retail, both sides we have been growing on average between 90 to 21% is what we have seen. The quarter-on-quarter performance and the year-on-year growth has been on those lines. In the wholesale side, we are seeing a fairly robust growth. We are seeing capacity utilizations increasing. And there's a demand coming in, whether telecom, the renewable energy space, or the data centers, the real estate, it's all signs of showing a pickup. On the retail side, the consumer demand remains robust. While the industry is guiding at 14-15% growth, we expect to grow at least 4 to 5% higher than the industry growth. So 18 to 20% is something which we are fairly confident about achieving.
Okay, all right. Hi, Harsh. Good morning. Nigel on this side, and congratulations on your new role. Well, just putting in that basic math of 18 to 20% for the next few years. Your current loan book size, I think, is around 1.8 lakh crore odd. That should potentially double, I think, in the next by around 2027 or thereabouts. But I just want to focus on a couple of aspects of your loan book. Your credit cards, your microfinance, commercial vehicles, personal loan. I think as of now, it's just around 8,000 on a base of around 1.8 lakh crore. And there is a lot of traction out here. From around 5% of your book, what do you expect the contribution to go to?
Okay, on an increasing book, we are looking at a share of roughly about 10% being contributed by the high margin businesses. Commercial vehicle, microfinance, credit cards, gold, and the MSME piece remain our clear focus areas. At this point in time, the MFI piece, the credit cards, and the commercial vehicle piece is about, as you rightly mentioned, about 7,000 crores. But broadly speaking, that's a segments which are growing at 60 to 70% right now, partly because of the lower base and also partly because of the fact that we see a high opportunities over here. To give you an example, in the microfinance, we were disbursing last year about 50 to 60 crores per month. Now we are averaging at over 200 crores a month. Similarly, for commercial vehicle, we've expanded our geographical footprint and covering pan-India now and leveraging on the branch network and the DSA network. And again, over there, our disbursements per month has more than doubled. Similarly, on credit cards, we are at 2,000 crores plus in terms of size right now, but we are growing at about 50% odd, a little bit on a smaller base, but significantly higher. So we expect as a part of our total book to touch about close to 10%.
Okay, all right. Harsh, just a quick question. Okay, yes. Quick question out here. Your fundraise as well as the way you're changing your mix, your loan mix, it could help your NIMs. Now, your NIMs for the past quarter were at multi-quarter lows, but you'll have said that it will recover from here on. So from around this 3.15% odd, what should be the broad range of NIMs for this year? That's FY24?
Okay. The NIMs have definitely been under pressure because what typically happens, the repricing on the loan book typically happens faster. So you saw the NIM expanding really fast and peaking for us in the Q3. and then you saw the deposit piece catching up. So we were at 3.2 in FY22, we were at 3.31 in FY23. And while the Q1 of the current year showed the maximum impact of the deposit repricing, we think that this is behind us now. And we are guiding a NIM of 3.3 to 3.35 for the current financial year. And we expect 7 to 8 basis points uptick in the next quarter and onwards in the NIM itself, because we see, one, the deposit repricing has already happened. Our impact of the high margin businesses playing in, we are seeing substantial traction over there. The other area which you're focusing on is obviously on the CASA side. It did see a fall, but you're looking at recouping that, especially the car piece. So all these put together, we are reasonably confident of achieving a 3.3 to 3.35 NIM, which we've been guiding for.
Okay, 3.3 to 3.35, you said. You were talking about how a couple of your businesses are picking up quite a bit, whether it's the CV business, the MFI business, and this is in high teens, the growth that you're seeing. What would this mean for slippages? Now, I know it's just a niggling worry, slightly higher slippages compared to what you did last time around at about 490 crores. And your slippage ratio, though, is still around 1.09%. But do you see any incremental pressure on slippages? What could the run rate be going forward?
No, we are still guiding at the same levels. We do not see any deterioration in the asset quality materially at all. 40-45 basis points is what we've been guiding for. And last year, Touchwood had been at a significantly better asset quality of 41 basis points for the full year. So we are guiding the same levels. We don't see too much of a traction. We are a reasonably conservative bank. So within those risk parameters, and obviously the situation is dynamic. So we have focusing on the high margin businesses, but reasonably risks boxed in. So we do not see the slippages going materially from where we have been guiding at. 40-45 basis points is what we will be guiding for.
Okay, so you don't see a material deterioration in asset quality, and that's always a good thing.
Right.
On the restructured book, your current restructured book stands at about 3,400 crores. Any update on that? How much of your book can go bad? And I'm assuming not much, but if you can just give us the numbers.
The restructured book did face a little bit higher slippages than obviously the normal book, but we have seen the checks on that part. We do not see any material disruption on that book either. The full impact of it will play out during the current financial year when the pains start coming in. But however, we do not see much of a challenge on our restructured book on the retail side either.
Okay, all right, Harsh, a final question before we let you go. You'll have a couple of companies that are part of the group, which you could be looking at unlocking some value, insurance arms and the likes. Is there some kind of unlocking of value you could see in this year itself, in the current financial year?
No, nothing. We are, which is there in the domain, we are looking at issue coming up for our subsidiary FedFina, which is there on the domain, public domain. At this point of time, we are not looking at monetizing our insurance piece at this point in time. So we are staying invested.
FedFina happens this year itself?
Pardon?
FedFina? You're looking at some fundraise, right?
Yeah. There's an IPO coming in. We have filed for the DRHP. So we are looking at a fundraise at the FedFina level. Barring that, there's no other plans to monetize any of our investments.
Okay. One final question then from our end, Harsh. Since you've just taken on the mantle of Executive Director, and you have experience across several sectors, right, within banking, whether it's corporate, commercial banking, wholesale, etc. For the next 2 to 3 years, what is the longer-term vision of Federal Bank? I mean, what will the focus area be? Whether it is on the digital side, whether it is in commercial banking, retail, what have you set your sights to do over the next 2 to 3 years?
Okay, there are quite a few exciting areas. On the fintech space, as you're aware, we are one of the banks with the maximum number of partnerships, both on the marketing side as well on the cost processes side as well. We continue to remain absolutely engaged with most of fintech partners. In fact, we are the go-to bank for most of the fintech partners. So that's one area which we are, because we realize that while we go the physical aspects with the branch network at 1,370 odd branches, we're looking at expanding our physical footprint as well. But our partnerships, and especially our digital partners, is something where we are clearly focusing on. So that's one area. In terms of businesses, which we already discussed, commercial vehicle, microfinance, cards, gold will remain a thrust area. they have a smaller base, but their share in the business is going to grow materially. And this sector-wise also, we see a huge opportunity over here. Coming to the MSME piece, we are largely a mid-market bank. Between our commercial banking and business banking, we have about 33,000 odd crores as a book size. We are looking to grow that book materially more at 20% plus levels in the next near to medium term over here. So the clear focus areas would be on the tech and the digital partnership. Second is the high margin areas, which we are looking at that point in time. Cost to income is another thing which we hopefully expect to taper off. The last piece which we are focusing on is on the CASA piece. We are at a 32% odd in terms of a CASA mix. We are looking at how we can raise that materially by becoming a payments and collection bank. And that is something which we are rolling out, a complete digital platform for the corporates, which we are revamping it, which will take care of collections, payments, trade, supply chain. Supply chain is another area which I missed out, is an area which we are clearly focusing on, which gives a higher risk-adjusted yields to the bank. So these are the clear focus areas for the next 2 to 3 years. I do see the banking in general to be fairly exciting, and more particularly, I think Federal Bank is reasonably well placed in the sector to leverage on that.
Okay, all right. Well, Harsh, valuations as well are in your favor. Thanks so much for joining in and giving us the outlook that you have for the bank, and all the best in this new role. We look forward to chatting up with you rather soon. So those are the big highlights coming in from Federal Bank, looking at doubling their book in the next 4 years or so. NIMs will be in that vicinity of around 3.3 to 3.4%, and also asset quality will improve. Don't see any big risk on that front.